Here we go, here we go, here we go, here we go. It's Fed Day. Let's go. Hey, what's going on, everybody? This is the blockchain backer bringing you the latest cryptocurrency news and analysis. Welcome to Fed Day. So, welcome to the live stream where we're going to watch the federal funds rate decision come out in about 9 minutes from right now. And then we're going to watch the FOMC press conference by Jerome Powell, the chairman of the Federal Reserve, as he gives his forward guidance to discuss what's going on with rates. As we all know, there's a lot going on in the banking world right now. So we're going to watch all of this live. We did this back in January. It was chaotic price action, likely to see the same thing happen right here in both directions. So we'll see what happens as this thing plays out. But let's go ahead and kind of get prepared for what we're looking at right now. So as we get ready for the rate decision to come out in 8 minutes, if you are tuning into the replay of this, you could skip forward from 8 minutes from right now at about the 9-minute mark of this live stream video, and you'll be able to see the rate hike. And then at about the 40-minute mark of this live stream, you'll be able to see the press conference of Jerome Powell. So, all right, here we go. Bitcoin has taken a little bit of a pop up here before we've gotten into the meeting. So we could see Bitcoin sitting at 28,487 as we get ready for this moment to begin. We could see the Dow Jones Industrial Average is down about 69 points. So we're down about 0.25% over here in the Dow, about break even over here in the S&P, and up about 0.33% over here for the NASDAQ as we get ready for this event to unfold. On the screen right here, I do have Bitcoin on the top. I do have the Dow Jones on the bottom. I'm on 5-minute candles, and we have 1 week's worth of price action in here. This is the one we're going to watch. As I do turn this on right there, you'll see that I'll have that playing for us. I'll make this bigger too. So while we're watching it, we can try to read his face a little bit better as Jerome Powell is speaking. But I'll save that for when we get there. I do have a zoomed out perspective as well for us. This is the last 2 years of the Bitcoin price chart and of the Dow Jones Industrial Average. So one thing about Bitcoin is we know we're at a pretty big resistance level sitting right here. This is the bottom that was placed back here in June of 2021. This is where we capitulated through there, where the contagion worries all set in. We are right back there at that level. You can see that if I zoom in on this, it has brought that little box over here to this chart. That is where we have hit right as we get ready to go into this meeting. We just back tested that level right here at that moment right now. So we are at a major resistance as we get ready to go into this. Looking over here at gold, the big question is who's going to be the winner between the Dow or the stock market and gold. We know that gold broke through the 702 retracement on Friday. So far, it has just back tested it. Nothing has happened here except we're sitting on top of it. So we'll see if there's a big reaction over here in precious metals as this all occurs. And then, of course, I got another chart over here with the Dow Jones. I've got us looking over here at the US dollar currency index, or the DXY. So we'll take a peek over at that too. Over here is the altcoin market for the cryptocurrency market, bouncing off of that previous all-time high, back above the 200-week moving average, back above the 50-week moving average right in here. And then the big one over here, this is the treasury yields and the federal funds rate. Let me see if we can turn the Fed funds rate on. No, we're not behaving, are we? I'll figure it out later. But we know that the federal funds rate, I want to put the Fed funds rate on here. Hold on. It's not cooperating. How about that? Decided to break as we get ready to go into this moment. Anyway, if I could draw the federal funds rate, it would look something like this. And so we know we're at like 4.57% right now. So let me clean that up. That is really kind of where it's at. It's about 4.57 is where the federal funds rate is. And so now, as we could see, the question is, are they going to raise by 25 basis points right now? As we could see, the 2-year yield has just completely demolished that, and so has the 10. Still not able to catch up to the last 2 rate hikes over here for the 10-year yield. And the consensus is, let's see what it is we're in the final minutes. This thing bounces around all over the place this morning. In markets in the morning, we saw it was a 10% probability that they would pause. Now it is a 16% probability they will pause, 83% probability for a 0.25% interest rate hike. I think a lot of people are not So you don't really care what happens here. The question is the wording out of the Fed after this with Jerome Powell on whether or not they are going into pausing and what is going on with banks. Is it something serious? Is it something to not worry about? So this will come out in the next 4 minutes. We'll keep an eye over here. I do also have the Federal Reserve's website pulled up, so we will be able to read their statement moments after it does get released. So I don't know if this website will start to crash a little bit in that exact moment, but we'll be able to check on it right in here and read what they have to say. And then 30 minutes later is when it's expected that Jerome Powell will come out and speak, and we will watch that right there on the bottom left of the screen, but we're just not there just yet. So anything else to go through here? Taking a look over at the stock market, still it's a mixed day. Like when we were doing markets in the morning, we were looking at it. Nothing was up more than 1%. Nothing was down more than 1%. So you have a couple of them that are a little bit over 1% down, a couple of them that are a little over 1% up, but still, like we just mentioned with these indexes or indices, whatever you want to call it, I think both terms are correct, indexes and indices. You can see the Dow is down 0.18%, the S&P is down 0.02%, and the NASDAQ is up 0.4%. With metals slightly in the green, dollar is down, mixed down here. You got natural gas getting crushed, but you have U.S. oil up slightly. So we are only 3 minutes away from watching this. Now, again, we typically see huge volatility erupt in these moments right in here. And a lot of times, the volatility can be up or it can be down, and it can be a fake out. So me trying to interpret what that data is, it will be impossible for me to do it at the time. We will just watch it to the end. And the rule is, if it's Wednesday, my dudes, people will request the frog today. The frog only comes out if we get to the end of Jerome Powell speaking and markets are ripping. So if we're down like 500 points in the Dow, or if Bitcoin's down like $2,000, not likely. Not likely. Only in a celebratory moment of surviving that moment would we bust that thing out. So in one thing to Rick, that's a very generous super chat. Thank you so much. Hello, backer. Asking about the XRP inverted chart and tell us what you think. Yeah, I'm bullish on XRP, but guys, in this live stream, I can't be looking at altcoins, man. This is going to be we're really dedicated to the moment that's going on right in here. Rick, just remind me later, man. I will try to get to your stuff, but right here in this moment, I can't do that. Dr. Tay says, I think we need Patreon contents where BCB can let loose. Thank you for all your hard work, my dude. Keep pulling the strings for us. Yeah. In my newsletter, I can say a lot of words. Like I can't even say C19 on here, but all right, guys. So here we go. We are 1 minute away from getting the interest rate decision. So we're now waiting to see if there's going to be volatility. Bitcoin sitting at 28,613. Expect typical volatility to erupt the moment that it does come out. Let's go ahead and start F5ing. And getting ready. So how much time do we have? We have 34 seconds left until we should be getting this. Here we go. We excited, man? It's going to be wild, dude. All right, 20 seconds remaining. $13, $12, get ready, man. Here we go. What's it doing in the seconds leading up to it? 3, 2, 1. Here we go. There it is. The committee to 4. Okay, raised by 0.25%. What's the market's reaction? Positive. Bitcoin up. Stocks up 0.25%. See if we've updated over here. They still haven't updated on there. Okay. Modest growth. So we will read this in a second. Hold on. Okay. Initial reaction. Okay. But remember, initial reactions don't mean anything. Dow up. Dow has flipped green, up 63 points. All indexes have flipped up points. Let's see. All right, we're going to have to read what their forward guidance is. Remember, we can get fake outs. This can totally be fake. Let's see. You should say 100% now, right? You still don't. You're silly. Okay. Okay. Here we go. Interest rate, 0.25%. Okay, let's go ahead and read it. Federal Reserve. And I'll keep my eyes on the top left of the screen to see if anything crazy is going on in the markets right now. One thing is gold is popping up as well. Let's see. How is crypto reacting in general? Crypto is reacting okay. More green on the board than we had just a moment ago. Let's go ahead and read what the Fed has to say. Recent indicators point to modest growth in spending and production. Job gains have picked up in recent months and are running at a robust pace. The unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4.75% to 5%. The committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. Let's read that again. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Essentially saying, hey, we're aware we've done a lot. Keep an eye on it. I know it's lagged. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previously announced plans. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So, all right, they pretty much dodged everything about the banks. So they make one statement about it, right? They acknowledge it. The U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. So dodge, divert to inflation. So we'll see. Looking over here at the market, so there was the initial pop that eventually happened right there after the release of that data, and then not a whole lot of follow through after that. See, green. Gold is following through. So gold is having a pop too, right? One is lying. Gold is lying, or the stock market is lying. Somebody is. Like we were talking about at the beginning of this, if you're just tuning in, we know that Bitcoin is sitting at its super resistance right in here. You know, we're right at it right now, watching the market to see how it's going to react as Jerome Powell comes up. So we can have initial reactions to what the rate hike is. So the way this has been interpreted based on everybody that I've been looking at and reading. So, okay, they do the 0.25%, right? So what does that signal to the market, right? That if they would have paused, there would have been the risk that the market would be concerned that the Fed is concerned. But the Fed can act like everything is fine, everything is dandy, we'll do the interest rate hike, we're not worried about the banks because the U.S. banking system is sound and resilient. So they're giving assurances to the market, everything is completely fine, and inflation, that is why we're still doing 0.25%. So, all right, Bitcoin. 28,800. Dow still rising. up about 100 points here on the Dow, so it's about 0.3%. The S&P is up 0.5%. The Nasdaq's up 1%. Lots more green over here on the board going on now. Coinbase, which was down about 3% prior to that rate hike, now almost break even. Crypto, we see a whole lot more green over here on the board for the cryptocurrency market after the initial rate announcement. Gold had a pop. We saw a big fall in the dollar. There we go. Dollar plunging. So big fall happening over here in the US dollar currency index. Altcoin market cap up. Let's see what happens here. Initial downward pressure. Let's put it on the 15 minutes. Initial downward pressure on the 2-year and on the 10-year. So they did not pop up. So we no longer have to say question mark. We'll come over here and let's put a little check mark. How about that? Don't make me use my sloppy handwriting to write a check mark. Do I put a rocket ship on there? Is the SEC going to get mad at me for doing that? Jeez. Enough time with 3,500 people here, and I'm looking for a check mark. What are we going to put? We're going to put... Oh my gosh. No, I can't put that on there. All right, we'll put that. Yes, they did do it. So it's check mark. They did do it. That is now the federal funds rate, 4.75 to 5%. This is so interesting because the 10-year has just never caught up to the last ones, and the 2-year just had a massive rejection right in there. Looking at Bitcoin still as we get here. So we're now 23 minutes away from when Jerome Powell is going to be speaking. So I am going to be flipping that on when we get there. Whenever he does go on there, I will shut my yapper. I will not be talking during that. And we will just leave him on to speak, and we will watch the charts do their thing without me talking. And so I'll flip that off right there. Let me just see if they've at least got this thing running. Yes, they do. Okay. Right? Yeah, it is live. Let's do that. I don't want the music. There, no music. This is live now. So just kind of waiting on it to do its thing. Bitcoin, 28,775. So we'll see who's fake out. It's going to be crazy, man. This is just the first part, right? So that's the we now have the answer. Now the question comes when the Fed comes out and speaks, do they reassure the market a little bit more? And do they tell us that they're at the pause? So altcoin market doing well, more of the market turning green still. That is, I don't like that, sorry. New people are going to tune in. They're not going to understand what that meant. Sloppy check mark it is. XRP, right? Still pulling back. Crazy day yesterday. Right back down into these levels as expected. Let's see what Bloomberg is saying. Fed says the U.S. bank is sound as banks are sound as it hikes rate by a 1/4 point. Yep. Again, here I will do this to. Nah, I can't do that. I don't know. All right. There we go. Now we have kind of a turnaround happen over here in the stock market. Again, we can't trust anything. Unfortunately, you can't trust anything that is happening here with markets right now. And we can't really trust anything that's going to happen with markets in the first few minutes of Powell speaking. It's going to be more of kind of like, how are things going as we get deeper into it? And he starts kind of reiterating what's going on in the markets. Let's take a look at crypto. How are we doing? Okay. So now we're just kind of in wait and see mode. So now the answer is out there. Again, I can read that again. I'm not going to read it again. But they have come out and they have said that the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. Just, that is a weird statement to make after that. I don't know. tightening. This is deflationary. Recent developments are likely to result in tighter credit conditions and to weigh on businesses and weigh on economic activity and hiring and inflation. These are all deflationary. The extent of these is unknown. We're going to remain highly attentive to inflation risks. The inflation risks are them printing trillions of dollars. This is a deflationary event. So then they divert and start talking about inflation the whole time and raising by 1/4 point. So it'll be interesting to see what Jerome Powell, he's probably going to read this whole thing, and then maybe he'll have a couple more statements to make, and then he will take questions from the audience. And that's going to be where we're really going to watch things. So now we are at the point where Bitcoin has pretty much taken back the initial pop. Again, nothing to read into it here outside of what's going to happen when that presser really gets going. And from a technical level, you can see where we're at. It's all right. Get a couple of these questions in here real quick. Ethan asks, I sound like a noob, but when it comes to transferring crypto to crypto, say Bitcoin to Ethereum within Coinbase, are there limits? Not within. If you already have it in there, you're welcome to move around as much as you want. So, all right, it will be 18 minutes, but thank you, Ethan. But no, not within. But if it's the limits come when you want to withdraw or if you're wanting to deposit. So we are now 18 minutes away from when Jerome Powell is going to speak. Stake XBT says they will always say that it's okay. Correct. So if you look throughout the history of the Fed, they are never going to come out and give it to you straight. Cody asks, what site is this for charts? This is TradingView. Not sponsored, but it's the site I'm always using. David George says, gold crashes, Dow, new all-time high. Currently, both of them had pops, right? So what we saw, the initial reaction was a fall in the United States dollar. The initial reaction was a pop in gold, which is now pulling back. And the initial reaction was a pop in Bitcoin and a pop over here in the Dow Jones Industrial Average, which they are all taking back right now. So remember, initial moves can be tricks, and then the moves when Jerome Powell starts speaking can be tricks. So that's our first kind of pop of volatility. Probably going to be a whole lot more. I think when we did this last time, when Jerome Powell started speaking, we saw the Dow crash 400 or 500 points, maybe 600 points in the first 15 minutes. And then we watched it take it all back and then be plus 400 or 500 points by the time he was finished talking. There we go. Bitcoin has taken it all back. Gold still has its gains. Dow Jones flips red, while the dollar still remains red. Jill laughs and says banks are sound and resilient. Yeah, I don't think people believe that. Known to Pone says saying the banking system is sound and resilient is a pretty big gamble. No, if things get worse, they're going to look dumb. I think they have egg on their face quite often. DD says the past 3 months, Bitcoin has mirrored gold and gone inverse to Dow Jones like gold. Yep, we covered that in the markets in the morning earlier today to show the historical connection of Bitcoin to the Dow. And it's just ever since we had the FTX collapse, that was the first divergence where the Dow continued up, but Bitcoin went down. And ever since then, there's been no real clean correlation for the last 3 to 4 months with Bitcoin and the Dow on that short of a time frame. Severdeen Labs, Fed, we're screwed, and there aren't any lifeboats. G-Man says, BC Backer, why do you sound so soothing? Have you considered a career as Morgan Freeman? You know, one thing I know, my voice does get more like warmed up in the afternoon. In the morning, it's not as warmed up as it is in the afternoon. AKP says, when I was a kid, I bought XRP for 42 cents because we've been there for 6 years. So, you know, the expectation was that we get a pullback over here in XRP. It is nice to see a little bit of hold up, but really 42. That is the target I'm looking for, at least 41 to 42. Everyman JWL says, thank you, BCB. This is a huge help. Yep. So for those who are just tuning in, what we're doing is we are watching the Dow Jones Industrial Average, and we're watching the stock, and we're watching Bitcoin. So Bitcoin on the top, Dow on the bottom. As the interest rate hike just came out, which was 0.25% in there. Really, the main focus in here is talking about inflation and continuing to target that 2% inflation. And this is interesting. So I didn't catch this real quick. We're going to go back to that in a minute. But the only statement they make in regards to the banks is saying the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risk. So this is all deflationary. And then they bring in the inflation risk discussion here. The inflation risk is how they respond, right? If they respond really aggressive, which they are, adding long-term inflation during a deflationary environment, then we go on to completely talk about inflation and that they're doing a 0.25% interest rate hike. So that does put them to where they discussed. That puts them at the 4.75 to 5% federal funds rate. I hand drew a federal funds rate because it's broken right now. The Fed funds rate is broken. So that's going to take them up to that 4.75 to 5%. And this has been the issue for the bank insolvencies. They've all gotten caught wrong-footed on long-dated treasury yields and mortgage-backed securities. So they're all sitting on these 1.75% interest rate bonds. And, they've gotten crumbled because treasuries have skyrocketed. So the Fed, to signal that this isn't a systemic risk, is still continuing to hike. I'm sure they are going to get questioned about that today. Part of me always wonders how much of this is scripted. You know, they're only letting certain people in the door to ask these questions. They're not going to bring in hostile people to ask questions, right? You know, they're not going to bring in Rattlesnake Joe to come in and say, hey, what is going on here? This is insane. They're going to bring in people that ask friendly questions, and maybe they even already know the questions before they get asked. That's my suspicion. So initial reactions by the market is dollar down, gold up, Bitcoin about even, Dow up. So we're kind of surviving the moment. So I think the market kind of got what they were expecting, and the market is slightly green. But man, I don't know. Not that I don't know, it's that I don't trust it. You guys know this. We've seen it. When Jerome Powell starts speaking, things can get very, very wild. This is not a very volatile move. This is pretty tame for what we typically are going to see, and I definitely think we will see more action today. So Jerome Powell will go live in 10 minutes, and we will move this thing up, and then I will go silent. So just kind of anticipate that if you're doing super chats, or if Bitcoin starts crashing by 97% in that time, or if the Dow starts crashing 9% time, or even if we get like a 100% pump to the upside. I will be staying silent during that. I don't want to interrupt it. We're just gonna watch it all together. I'm not going to give any type of take on it. I won't give any type of take on it even when it's over. So I don't know how the market's going to react during this. We're going to watch it and find out for ourselves. But the Fed acted in line with what people expected, that they would come out, do the rate hike, signal to the market that everything is okay with the banking system, and that their main focus is inflation. That was the expectation of the market. It's what we've discussed in Markets in the Morning for the past week. That would be my best guess. They would raise the 0.25 and that they would signal that everything is okay. Now comes the question of their forward guidance on what they think is going to happen in regards to future rate hikes and what Jerome Powell says about that. In December, he signaled that they would raise by 0.75% throughout 2023. This is their second 0.25% interest rate hike. That means they would only have 0.25% remaining to go for the year of 2023. And of course, we should all know at this point, the banks are in distress right now, sitting on massive amounts of unrealized losses due to this hiking cycle that they've done right here. So waiting to see what is going to happen when Jerome Powell speaks, because this volatility could get sketchy. But if you're hanging out in here, there's 3,300 people in here. If you could please hit the like button, helps the channel out tremendously. And I'm ready to shut my yapper. I'm ready for this thing to get going. Let's just see what happens. Otherwise, we're just kind of sitting here watching we're watching data that doesn't seem like it's the real thing. The real thing is still waiting to come. Still waiting for the market to react to what Powell is going to say. Initial reaction was gold. Remember gold? All right, hold on. Had to get the cat out of here. Gold broke through the 702 retracement last week. Right now, it's currently sitting on top of it, getting a bounce right off of it. So who's going to be the winner, gold or the stock market? That's where we're at. So metals are doing okay, stock market doing okay. Not a whole lot of change to treasuries and not a whole lot of change to the stock market. And the cryptocurrency market, slightly more green than it was prior. So now it's kind of taken back a little bit of that initial pop, and we're just waiting, and we will see Jerome Powell go live in 7 minutes. Who's Crypto says, do we know what day it is, my dudes? So, right, and we talked about that too, right? So it's Wednesday, my dudes, only comes out in the event that the stock market is up or the Dow is up at least 300 points after Jerome Powell speaks. If we're tanking, which very possible, no, it's Wednesday, my dudes. Wednesday, my dudes, is only for celebrations during Fed. David says, David Darvishin, I didn't know you had a cat. Yeah, we have a cat and a dog and 200 fish now. If you remember, it was only like 5 fish in the beginning. It's definitely closer to 200 now. Randall's Rest with the super chat. Thank you. Thank you, David, and thank you, Randall's. The super sticker. Ryan Gerritsen, thoughts on Zcash and poor performance? It is definitely a laggard. Your mic volume has been going up and down. That might just be me inconsistently moving away from the mic. Vlad Ponzar, thank you. But now that there are some super chats coming, let me remind people, I'm not going to be doing any in this stream. This is not, I'm not going to be like analyzing any type of altcoins or anything like that in this. Please save your money. Of course, I appreciate the super chats and supporting the channel. It's very kind of you. I sincerely appreciate it. But that's not what this live stream is. There's 3,500 people in here. We're not going to be covering altcoins in here. We have a very specific topic here. We're watching what the Fed the markets are going to do in response to all of this chaos. So again, this is supposed to go live here for the Fed. And also I am turning my head and looking at all 3 monitors that I have. So that might be why my voice is going in and out. Jerome Powell is supposed to be coming live in 5 minutes. Again, what we have seen from the Fed so far is that they did a 25 basis point rate hike, which was in line with what expectations were of what they would do. They did end up going there. And we can see that the 10-year and the 2-year are still not responding like, hey, okay, that sounds great. They're heading down still. Gold has had a positive reaction. Bitcoin about break even. Dow Jones up just a little bit. It's still, you can see it's just bouncing back and forth between positive and negative. I think we're really going to wait to see what happens when Jerome Powell starts speaking and things start getting chaotic. And again, I'm going to shut my mouth during all of that and just let the market go. I'm going to turn my mic muted and God help us all. So, these two statements are the important ones. So first of all, so what is all this? So I don't have to go into all this. They say we're raising by 0.25%, and we are focused on 2% inflation. That is what all of this says right here. We're focused on 0.2. We're focused on 2% inflation, and we raised by 0.25%. The first things that they say here are recent indicators point to modest growth in spending and production. Okay, that's the thing I wanted to come back to. Okay. Recent indicators point to modest growth in spending and production. I saw TXMT Trades post something today. Let's get it. Here we go. From Carl Quintanilla from Citibank 4 hours ago. This was the first week of Citi credit card data following the disruption with the financial sector, and we were curious if it might have had an impact on the consumer. It sure did. It's the biggest decline in total retail spending since the pandemic began back in April of 2020. But here in the Fed, they say recent indicators point to modest growth in spending. They're looking at lagging data. They're not looking at data that is applying to the current time right now. So, interesting. Make sure I didn't miss anybody in here. You guys can hear me okay, right? I don't need to ask that. You can hear me. You'd be screaming at me if you couldn't. All right. So I'm going to go ahead and turn the volume on here. Are down, even though the Fed rose 0.25%. Slightly up over here in the stock market indexes. Metals are up. Dollar down. Dollar takes a big spill right here on the announcement of the interest rate hike. Looking over here at the cryptocurrency market, we were mostly red with only like one or two in the green, with Bitcoin being one of them prior. Now we've got a couple more in the green over here, but still mostly a red market here in crypto as the altcoin market has squeaked through that 50-week moving average over there. They went ahead and they went to the interest rate hike level expected. XRP still crazy like this. I think we're just following its own algorithm of trading over there on XRP. But there we go. Bitcoin 28,552 as it sits just below the resistance level, which was a support level dating back to 2021. Here we are, 2023. All right, guys, that's it. I'm going to shush my mouth. Here we go.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes may be, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilek from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so For our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. You know, I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, so, but that will be up to him. So that's really where it is. You know, the review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that, you know, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, you know, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, you know, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question, would you be open to an independent investigation separate from the Fed's probe?
I welcome it's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails their investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Okay, Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No,
Thank you.
absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Kyle.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet the special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Katerina.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Let's go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review is going on. And I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So,
Thank you.
thank you very much.
Ladies and gentlemen, there we have it. Your Federal Reserve Chairman, Jerome Powell. Boy, I was reading the chat, and I had a lot of the same opinions that you guys did during all of that. But there we go. We've gotten through it. Let's take a look at what the price action did during that whole train wreck. I think that's how I'd describe it. I'm going to have to watch that again and get the takes of what other people thought of that. My initial take on that was just like a lot of what you were saying in the chat. There was a lot of lying that went on there right there. All right, so obviously we all watched it. Bitcoin was tanking during that whole moment. Looks like it found somewhat of a temporary bottom right here at 27,200. The Dow too, lots of volatility happening over there. A little bit of a zoomed out view gives you a better idea of how big the move was there. There's your Dow. There's Bitcoin right there. We know Bitcoin, it's back at this significant resistance level right in here, and it had reached up and poked it just before that presser ended up starting. Gold, little volatile action in there as the pressure was going on. So you can see gold is still holding up positively. Let's look at the markets, right? So really just surprisingly not that volatile. I get it, in Bitcoin we saw some big volatility, but not too crazy over here in the stock market. Looking at the dollar. So the dollar, I saw all you guys, dollar's tanking, dollar's tanking, dollar's tanking. Of course, we found a little bit of support. One thing I was kind of keeping my eye on was XRP. And I get it, there's 4,000 people in here. Like, you guys are like, I don't care about XRP. The target area for me for XRP was getting that 41 to 42 cent range. So we clipped 42 right there. And we're seeing a little bit of support showing up here for Bitcoin. So we'll see if there's follow through that ends up coming in on the market after this. But the main things that stood out to me in my initial watch of this is he definitely didn't sound that dovish to me. I was expecting him to come out and be a little bit more dovish. And, I get it. A lot of Bitcoiners want to hear that rate cuts are coming. He communicated that rate cuts are not coming. For us here on this channel, we have studied that to see what happens when the federal funds rate does start to get cut. That is usually very bearish for markets. It is not a bullish thing, the start of cutting. So that's a little bit of reassurance to hear that cuts aren't around the corner. The big question is the pause, which he did mention. They considered pausing today, but they didn't do it. I think one of the more concerning things about the responses that he had was when he stated kind of like they didn't know what happened with the bank. And we all saw him dodge that one question about whether or not they knew of the risks. So, you know, his response when first asked about what happened with Silicon Valley Bank was, you know, they overexposed themselves to treasuries, didn't hedge, and then they had a bank run. And then he's really focused on the bank run, but super glossed over their overexposure to treasuries. And a lot of the, you know, the people in the Wall Street knows this is a big problem. The unrealized losses that are taking place in banks right now are huge, all from this. And he really played dumb. I don't know about that. That was interesting. I'm going to have to rewatch that again to get a better take. You know, of course, when I'm running this live stream, you got 4,000 people in here. I'm screen capturing multiple windows, and I've got a lot of different things going on and trying to make sure I'm timing things properly. It's hard to have 100% perfect focus on what's actually happening in there, but I did my absolute best. But I didn't walk away feeling that they've got a handle on it, and I definitely didn't walk away feeling like they're being honest. They definitely felt like they were being a little bit dishonest in there. So I look forward to seeing the take from the Fed pros out there on what actually happened in there, like Danielle DiMartino Booth. And wow, I don't think that went the way he wanted. I don't think it did at all. I think that went very poorly for him. And what do I know? I'm just a crypto degan. But yeah, so there we have it, guys. That was the price action. That was the volatility we saw from the market. The second he shut his mouth is finally where the market found a little bit of support. And one thing is XRP got right back down to where we're kind of looking for some support to start showing itself up at. So that's good. We'll keep an eye on it throughout the evening into tomorrow to see if that can remain as a supportive area in there. Of course, you just kind of zoom out a little bit and kind of see what happened. Pretty decent sized candle in there. We'll see if there's any follow through to it. Looking at the dollar, yeah, turned itself back over a little bit, right? Had somewhat of a bounce. Then the second Jerome Powell shut his mouth. I don't think he did good. I think he did really, really bad. And you could sense, I often wonder, is there someone whispering in his ear how the stock market is performing? You saw it when the stock market turned up a little bit. When this was happening, he suddenly was very comfortable. He was having a good time. He was like cracking jokes, like, don't know if it's a feature or a bug. And then once this thing turned over and started tumbling after he knew he was lying straight through his teeth about not really knowing what happened with Silicon Valley Bank, stock market started tanking. He knew that he just probably got caught in this lie. That was weird. But all right. There you have it. That's your volatility of the day. We'll check in on this again tomorrow to see if there's going to be some serious follow through to what happened in there and what the experts have to weigh in on that. Otherwise, dollar down, gold up, Bitcoin and crypto down, still mixed over here in the stock market. The only one who's really kind of taken a hit here is Coinbase. Yields slightly down, mixed over here on the indexes. Metals up, dollar down. Still mixed down in here. So there you have it, guys. There's your unelected official of the Federal Reserve who controls everything that goes on with your money, Jerome Powell. So we'll go ahead and wrap this thing up, guys. That was it. That was a Fed presser, 25 basis point rate hike. Not the most confident responses. At least my initial response. My initial reaction to Jerome Powell was a lack of confidence. That was my thoughts. All right, guys. No frogs today. We don't have insanity today. The frogs have to be respected and celebrated for when they're good. But hey, look, market's turning up a little bit. Maybe we can do the frogs tomorrow to respond to it. But otherwise, I hope that you guys are having a wonderful day. Been a long day, a lot of streaming out here. And I want to thank you for tuning in. I will catch you guys again tomorrow in Markets in the Morning, where hopefully we can turn this thing around. Till then, catch you then. All right, that's it. Thank you so much for watching. If you could, please like this live stream and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. I forgot to get you XRP Revolution. So I think it's intimidating to have money in the bank, even if it's less than 250K. Maybe. Hard to know, man. Gator. Thank you so much. All right, guys. Have a good one.